Hello and welcome to Morning Brief Market Sunrise. I'm Josh Schafer, in for Ramzan Karmarli, live from Yahoo Finance's studios in New York. It's Thursday, July 17th. U.S. stock futures are muted this morning as the independence of the Federal Reserve is once again in question. We'll have the latest on growing tensions between President Trump and Fed Chair Jerome Powell. Plus, earnings season rolls on. We'll have the latest numbers from Taiwan Semiconductor and PepsiCo. And finally, we'll be taking a closer look at Starbucks shares, which are under pressure this morning as a second Wall Street firm has downgraded the stock. So grab your coffee and let's own the morning. Let's kick things off with what you need to know before the opening bell rings on Wall Street. First, taking a look at futures here. It's a bit of a mixed picture, but you're seeing futures tied to the NASDAQ actually turning perhaps slightly negative now, had been higher, but tech really has been leading the action so far this morning, and that's following the latest earnings results from Taiwan Semiconductor. The producer of AI chips said its net profit soared more than 60% over the prior year during the second quarter, surpassing Wall Street estimates and sending shares higher in pre-market trading. TSM executives called out NVIDIA's re-entrance into the Chinese market with its H20 AI chip as a key tailwind for the business, while also noting that U.S. tariffs could be a headwind for the company by the fourth quarter. Still, the positive outlook on AI demand from TSM sending U.S. stocks tied to the AI chip trade higher in the pre-market, with both NVIDIA and AMD up slightly. Elsewhere in chips, SK Hynix shares are under pressure as Goldman Sachs downgraded the Korean chipmaker, citing expectations of increasing competition in the space. With chips driving the action in tech today, Trump's trade war still remains a key focus for the broader market. The Financial Times reporting this morning that the European Union is preparing a potential list of tariffs on U.S. goods, while President Trump is preparing a list of his own. Trump telling reporters at the White House he plans to send letters to more than 150 countries, notifying them of a tariff rate in a range of 10 to 15%. Trump, though, noting that the latest list will include smaller countries that, quote, don't do that much business. Tariffs haven't been the only way that President Trump is driving markets in recent days. Reports Wednesday morning from multiple media outlets pointed to Trump advancing his efforts to remove Federal Reserve Chair Jerome Powell. The initial news sent stocks lower as long-term Treasury yields climbed and the U.S. dollar weakened. But that trade has quickly reversed right after Trump said this.
No, we're not planning on doing anything. We're very concerned. He's doing a lousy job, but no, I'm not talking about that. Fortunately, we get to make a change in the next, 8 months or so. And we'll pick somebody that's good, and we'll pick somebody. I just want a fair job. We want to see lower interest rates. Our country deserves it.
Yahoo Finance's Josh Lipton spoke with former Federal Reserve Bank of Richmond President Jeff Lacker to break down the risks surrounding Fed independence. Let's take a listen.
The way financial markets reacted, it's consistent with other reversals the administration has made to policies that provoke adverse reactions in financial markets. So it's not a surprise. Unfortunately, it's consistent with an administration that does not seem to be aware of what is in its best interest ultimately.
Jeff, can the president actually fire the Fed chief? Is that even an option?
So as I understand the law, and as it's been, and there's some ambiguity about this, but the for cause is a possibility. That is, if he has cause. Now, cause isn't spelled out in the statutes, but malfeasance or gross negligence, things like at that kind of scale might satisfy that criteria. Whether this building project dust up satisfies that criteria or not, I sure don't know. But it doesn't strike me as beyond this administration to rely on a pretext that has a bit of thinness to it.
Jeff, on this next question, I'm asking you to speculate. I realize that, but I am just curious. What do you think Jay Powell makes of these reports? He's watching these headlines too.
I think it's something he regrets and isn't happy about, but I don't think it changes what he does. I just don't think it changes what the Fed does. I think they go straight down the middle of the fairway and call it the way they see it.
Trump has made it clear, Jeff, what he wants. He wants them cutting. He thinks they should have already been cutting. They're late. Jay Powell has indicated, listen, he wants more data. He wants to see how the tariff inflation plays out. So he's willing to wait and see right now. In your opinion, is that the prudent move?
I do. I think the the yesterday's CPI report indicates that it's certainly plausible that a pulse of inflation is in the pipeline and is going to show up over the next several months. I think it'll be several months before we have a sense of the magnitude of that. The September data isn't going to come until October, so be surprising to me if before December, say, they had a really good idea of what the magnitude of the inflation effect of the tariffs is going to be. Until they do that, I think they gotta pretty much hang tight.
We're taking a look at some key market movers this morning. PepsiCo and GE Aerospace reporting earnings ahead of the open. Let's start first with PepsiCo. Second quarter results hitting the wire a short time ago, beating estimates on the top and bottom lines. Core earnings per share coming in at $2.32. That was versus estimates for $2.03. As for net revenue, that came in at $22.73 billion. Strong international numbers helping drive sales growth there. The company, which also owns Gatorade and Quaker brands, maintained its annual outlook. So Pepsi coming out and maintaining its annual outlook here, perhaps another sign that the consumer continues to hold up. We've heard that earlier this week from several large banks. That's been a key theme for the week across earnings releases, but sort of zeroing in on Pepsi here and sort of what the story has been. Stock has entered this release down about 10% year to date coming in. You can see on your screen there, down over 18% over the last year. Pepsi is one of many consumer staples companies that has been under pressure as the new Trump administration has been making this push for healthier foods. Pepsi trying to figure out new solutions for that. That's been a key discussion going on with the company. Will be interesting to hear what they have to say about that on the call, as well as last night, President Trump coming out on Truth Social saying that Coke had agreed to use real cane sugar in its drinks. That will also likely be a focus on this Pepsi call, but again, shares are higher right now. I want to move on to our other earnings mover, GE Aerospace. That stock jumping after better than expected second quarter results, and the company also raising its full year guidance. The company seeing a rebound in demand in the aviation market, that offsetting some softness due to the global trade war. And demand to fix older airplanes also driving the company's increased guidance. Airlines are holding on to planes longer because of delivery delays from Boeing and Airbus. GE shares up over 60% so far this year. This has been one of the top stocks in the market that we have been keeping our eye on, so it looks like that rally continuing at least in the pre-market right now. We've got much more ahead on Morning Brief Market Sunrise. Up next, a look at one indicator on the health of the market. Plus, we're checking the crypto trade as Washington's crypto week appears back on track. Welcome back to Market Sunrise. The S&P 500's latest charge to record highs has been a narrow one. The technology sector has been the clear outperformer, with that sector rising more than 6% over the past month, outpacing the S&P 500's nearly 4% gain over this period. So this has been sort of that Magnificent Seven trade a little bit. Also some other large cap tech names really getting into that rally. When you think about an Oracle, you think about a Broadcom. And what strategists really tell you when this starts to happen is narrow breadth isn't necessarily a bad thing in and of itself, but it is a sign that really only one trade is working right now. And they would sort of argue you want to see more broad participation in this market, especially with the S&P sitting right near that record. In order for the market to keep chugging higher, you would probably need things to start to spread out. Of course, we are now in the heat of second quarter earnings season. Perhaps that could be a potential catalyst if the earnings for those 493 companies outside of our Mag 7 start to pick up earnings, as many analysts have been hoping for several quarters now. But I want to dive deeper into this trend with Stocks and Translations host Jared Blickery, who took a closer look at the market's latest bout with bad breath and what it could mean for the market moving forward.
On Monday, the S&P 500 closed down with a small loss of 0.4%, but only 49 stocks closed higher, while 453 closed lower, which was the worst showing for a loss this small in at least 3 decades. In this edition of Stocks in Translation, we're going to take a look at market breadth and market internals. Now, first, let's take a look at the definition of market breadth. It refers to how many stocks are participating in a move, whether to the upside or to the downside, and there are many different ways to measure measure it. So first up, I'm going to take a look at the S&P 500, which is in the top part of this chart here. And in the bottom, we have the percent of member stocks that are above the 200-day moving average. Now, this is a key level that technicians look at that tells you at a glance, should you be bullish or bearish? So I'm going to circle here. This goes from 0% to 100%. And I want to highlight some of the bear market lows that we've had here and the advances off of that we've seen. Here's 2011 after the S&P downgraded U.S. debt. Here's after the bear market of 2016. Here's 2020, that early COVID rebound. Then we had a bear market, and then there was another one in late 2022. But what I'm showing you here is that rebound in 2022, which kicked off the current bull market, that was not very strong. And we've seen breadth here kind of oscillate and not really break up the way that it has done in the past. So you put it all together, this chart is not saying that there's a lot of internal strength in the market right now. And in fact, if you've been paying attention to the headlines over the last few years about all the mega cap dominance, the Mag 7, that's not a surprise. So this just kind of reflects that reality. But what's a little bit concerning is that after this near bear market miss that we just had post-Liberation Day and this rally, we've barely gotten above 50%, and that is just not historically strong. So now I'm going to show you a different measure of this. This is the S&P 500, again in white, and here it's on a log scale. And then in green, I'm going to trace this out. Might be a little bit hard to see here. This is actually the S&P equal weight divided by the market cap weight. And so this tells you when it's higher, this means that more stocks are performing. And in fact, this huge surge that we're seeing above that came off of those 2009 lows, that was when we had record QE stimulus, the first QE stimulus in the US, a lot of fiscal stimulus as well. We saw a lot of breadth and participation from all the members in the stock exchange, stock market. Now, what we're seeing here, you can see we've had this steady decline over the last 2 years of this bull market, so that it's actually at the lowest levels since 2009. That was the end of the global financial crisis. And you could actually go a little bit further back into the beginning of the century. It was lower coming out of the dot-com bust, but this is historically low right now, and I find that concerning as well. I have one more measure that I want to show you here. You might have heard of the advanced decline line, and this is simply for the S&P 500, which we have here in white. The green line is the advanced decline line, and let's say on any given day, let's say there are 300 stocks moving to the upside in the S&P 500 and 200 to the downside. Well, you take that 300 minus the 200, and that equals 100. You take that total every single day, the winners minus the losers, and you add it to the total. And that gives you this line that usually tracks the underlying market. Now, sometimes there is a divergence, and what I want to point out here is that even though we're at record highs right here, we are also experiencing record highs in this indicator. So one of these three indicators I've shown you in these boards right now is showing some confirmation of these record highs in the S&P 500, but most are saying that there is a divergence. I'm going to close here with a final chart. This is the S&P 500, put this on a line chart basis, and this is year to date. And what I want to show you is we have those February highs right here, and we are just above them. And my concern is that with all these divergence measures, if we were to go back below this red line here, those prior highs, then we would have a situation where we're probably going to maybe test some of these lows in here. So tune into Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
We're keeping an eye on crypto today, as well as Crypto Week in Washington gets back on track. Overnight, Republicans dropped a 2-day blockade on several crypto bills, opening the door for a full House vote. Of course, members of the administration, including President Trump, now believe that those bills will eventually be passed. We've seen that started to be priced into the market here. Interesting mover yesterday was Circle. So these bills, some of them center around stablecoins. Circle, of course, a recent IPO, very heavily involved in stablecoins. You can see that the 6-month chart looks pretty crazy, of course. It had a massive rally in June. Then what was interesting, though, is you can see stock had sort of stalled out from June into July. The stock actually fell about 20% from its highs. But then yesterday, as this news starts to continue to roll out of Washington, a massive rally again in Circle. That stock adding 20% in Wednesday's session alone. It will be interesting to track if Circle now can get back sort of into that momentum trade that it had been in June. Also been interesting to watch the exchanges. So the wild run for Robinhood has really continued here. Robinhood is up over 170% this year. That stock was up over 3% yesterday. Coinbase also rallying on this news. These exchanges, of course, benefiting from the legislation. And then from a coin-specific stand base, it's been kind of an interesting story when we think about just these crypto coins. Of course, Bitcoin recently hit a record high at 122,000, but I've had my eyes on Ethereum. Ethereum actually outperforming Bitcoin recently. You can see that in the blue line on your screen there. Ethereum up over 9% over the last 24 hours. And it's been interesting to watch sort of this spread of the crypto trade, right? It felt like maybe Bitcoin hits 122,000 before this bill is even passed, before we even know what's going to happen in Washington this week. Remember, that was back on Monday, I believe, that Bitcoin hit that record. And so you're starting to see the trade spread to some other coins, right? You're seeing Ethereum catch a bid, Solana catch a bid. And so this crypto trade continuing to broaden out. It's not all about Bitcoin right now. Investors looking for some other opportunities there. Coming up, though, we got the latest on earnings from drug maker Novartis and what to be on the lookout for when Netflix reports after the close. Welcome back. Time now for some trending tickers. We're watching Coca-Cola, Novartis, and Netflix. First up, Coca-Cola. President Trump posting on Truth Social that the company has agreed to use real cane sugar in its drinks in the United States, but the company hasn't confirmed the change yet, only saying in a statement that details on the, quote, new innovative offerings will be shared soon. The implications of the announcement reaching beyond Coke, the bigger movers are in corn-related trades. Corn futures edging lower on the news, and shares of producers of high fructose corn syrup, including Archer Daniels Midland, which makes products for some Coke drinks, and Ingredion, both falling sharply ahead of the open on Wall Street. And take a look at Novartis, the drug maker reporting earnings overnight, the results coming in above expectations and announcing a $10 billion share buyback. The drug maker also raised its guidance for the second time this year. But the good news overshadowed by the retirement of the company's chief financial officer after a decade in the role. The stock also under pressure after sales of a key drug missed expectations. That drug is widely viewed as crucial for the company's future, as some of Novartis' top medications face patent expirations this year, meaning generic versions will hit the market. And the stock to watch after the closing bell is going to be Netflix. It's the first of the big tech companies to report second quarter results. Here's a look at the expectations on Wall Street. Revenue expected to jump to just over $11 billion, up from $9.5 billion a year ago. As for earnings, the estimate is $7.09. Valuation remains top of mind for analysts and investors. Stock is already up roughly 40% so far this year, and it's trading near its highest level since 2022. The content lineup for the second half could also be a boon for the stock, which includes a new season of Stranger Things. The other thing to watch with Netflix here is really just going to be the day after stock reaction that we're starting to see for a big tech company that is already back near one of its highest levels ever and has seen a massive rally. It will be interesting to see with the market also near a record high and a lot of that driven by tech. Are investors still willing to pay up for these companies if Netflix does come out with solid results, or have expectations gotten too high? This will be an early tone setter for second quarter earnings season. We'll be excited to watch this one after the bell, and we'll have all that coverage for you live here on Yahoo Finance. Time now for our call of the day. Starbucks. Shares of the coffee giant falling after the company was hit with a downgrade by Jefferies to underperform from hold. The price target on the stock, $76. Analyst Andy Bear is saying there are no clear signs of meaningful or lasting fundamentals yet, and quote, expectations are too far ahead of reality. And that marks the second sell rating on the stock this week. Melius Research initiated coverage with a sell and an $80 price target. The analyst behind that call, Jacob Aiken-Phillips, joined Josh Lipton on market domination and explained the difference between how much people are paying and store traffic and why that was a key driver for his call.
It's checks up 42% since 2019, fiscal 2019, and traffic's down like 10%. Check is more than just pricing, you know, because they've introduced food and like people are buying more items. But just in general, traffic's down, pricing's up, And it's a hard value equation to fix, and they've been trying to reinvent themselves over the last year or two, and it's stretched longer than people have expected. And I expect it to be a bigger burden on their margin and growth profile over the next few years compared to what the consensus seems to believe.
And so when you told your clients on that one, Jacob, that one was a sell, if they came back to you and they said, how could you be wrong, Jacob? What's the upside risk I need to think about? You would tell them what?
Well, the new CEO, Brian Nichols, is very good, very well respected. The market seems to believe that the strategy is going to work. The whole third place, really focusing on basics, putting some more labor back into the stores. It's just, does that translate into traffic? And can their promotions like the summer berry refreshers or the ice horchata, can that drive traffic beyond just the value equation? Because value is more than just price. Value is convenience, it's innovation, newness, and just everything that the consumer looks for. But the price equation has gotten out of whack.
The Federal Reserve at top of mind for investors right now after the back and forth over whether President Trump would fire Fed Chair Jerome Powell. President Trump putting that idea on the back burner for now, but heavy hitters in the financial sector, including Goldman Sachs CEO David Solomon, speaking out, highlighting the importance of an independent Federal Reserve. Yahoo Finance executive editor Brian Sozzi sat down with Carlyle Group co-chairman David Rubenstein and asked him that very question.
Well, I think the markets would respond better if somebody is seen as independent. The candidates that have been mentioned, some of them are excellent, and I think they would be somewhat independent. But obviously, many of them have close relationship with the president. The president made it clear what he wants. Some of the people or candidates have already said they would lower interest rates. So maybe their existing view is that interest rates should come down and not because of presidential pressure. But I think overall, it would be a good thing for the country to have a strong Fed chair and succeed Jay Powell rather than a weak Fed chair.
It's going to be a busy day when it comes to Fed policy. Several officials on the calendar set to speak today. Fed Governor Adriana Kugler giving a speech later this morning on the housing market and economic outlook. And this coming after New York Fed President John Williams said last night that he's reluctant to support cutting rates at this month's meeting. Now, that has been sort of driving markets in the back here. I want to take a look at just how stocks are doing this morning. Really relatively flat right now. We mentioned earlier in the show yesterday, of course, the potential of President Trump firing Jerome Powell kind of took hold of markets, but that really only lasted about an hour. But what's been key to watch within that has been the moves in treasuries, right? We've had our eyes on that 10-year. It's right below 4.5%, which has been kind of a key psychological level that's weighed on stocks. That, of course, often moves off economic data as well. We have retail sales coming out at 8:30 this morning. Will be interesting to see if that continues to show solid spending for the U.S. consumer. And if it does do that, then overall, that probably could hold the market where we are, at least for now. That's going to be it today for us on Market Sunrise. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day, streaming and online. I'm Josh Schafer. Go on the morning.